Jeff Rosenberg, does this adjust a fixed income view of BlackRock?
Yeah, you have to understand this is a big pushback to the slowing, and it's a reminder of what Powell tried to say to the market, though the market wasn't listening. That their main concern is they're not yet seeing the impact of their tightening in the labor markets, and so this is a very clear message and a really kind of important warning that perhaps the interest rate sensitivity, put housing to the side, put the interest rate sensitivity of the economy to the Fed's tightening to date. Yes, there are long and variable lags, but we haven't really seen that degree of tightening. And when you take the financial conditions easing, the combined is perhaps what we're seeing here is the inability of the Fed to really get to its goal, which is to rein in the inflation pressures from a market. Powell said it again on Wednesday. It's still a labor market that is too hot.
Given that we are not seeing wages, Jeff, increase to the degree that some people might expect with such a headline blowout number, do you take comfort from that, or do you disregard that as a compositional effect of what jobs are getting created right now?
Yeah, the AHE number in terms of giving us a read on wage inflation is probably the most distorted because of the mix shift. Earlier this week, we got ECI, you've got ADP, and you've got probably the best measure, the Atlanta Fed wage tracker. At least those latter two are still pointing to an elevated level of wage inflation that I think is still very concerning to the Fed. Again, Powell was explicit when he said that earlier this week. The market wasn't listening. This report is a reminder that the hot, tight labor market is still going to be an issue for the inflation outlook and for the Fed outlook.
How would you play this then, Jeff? If you really trust the headline number more than you trust the wage number, why would you buy 10-year treasuries where they are if you believe that this Fed could be that far behind the curve maybe later in the year before it's apparent?
Well, it's a good question, Lisa, and you asked about 10-year treasuries, and I think you have to be a bit cautious here on the degree to which we've seen the rally in back-end yields, and you don't have to buy those yields here. You can buy the shorter end of the market. The curve is at a historic level of inversion, and I think there's more vulnerability as a result of that. And from today's report and what we're seeing, not just from today, but for a long time in the data, the degree of tightness in the labor market may really challenge the ability of the Fed to deliver that pivot that the bond market's pricing in for the second half of the year.